Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor, and in today's video we're going to be going through the Halifax House Price Index for July 2021. Now what I've decided is I'm going to do this every single month. As soon as it's released, I'm going to bring these videos to you. I'm going to give you the headline data, I'm going to give you my commentary as well as commentary from places like the HMRC and the Bank of England. So really good data sources so that you can make your own opinions. And I think by having this information, you're going to be able to make informed decisions when it comes to your investments. Now, if you like this sort of stuff, if you could possibly give this video a big like, it really helps me out with the algorithm. And if you haven't already subscribed, please consider subscribing. There's many reasons to do so, not only this content, but also the fact that we give away the dividends from our subscriber dividend portfolio every month, and I'm hoping to give away an investment house as we approach 100,000 subscribers in the near future. So guys, get subscribed and hit that bell notification if you haven't already. Now let's start off with the data exactly as it is on the house price index. And Nick, if you put the picture up, that will really help everybody be able to see that. So hopefully you can see a picture at the moment in the corner, and I should be talking on the other side. We've got £261,221 as the average house price in the UK at the moment. Now that is up 0.4% month on month, and quarterly it's up 2.4%, annually 7.6%. Now I appreciate there are some regional differences on that, and I'm going to go down and break down some of that with you in a moment. But the other thing I wanted to sort of make you aware of is that I put my own portfolio up here as well. So as you know, if you're a regular viewer of this channel, if you're not, I've got about £3 million worth of property in terms of value. Obviously I've got the mortgage, but in terms of value, they're worth about 3 million. And for me, if house prices have gone up by 0.4%, that means I add £12,000 to my equity, the money that's within the properties, i.e. the equity that's there, of about £12,000 in July, which is absolutely fantastic. Who wouldn't want to add 12 grand in a month? So what we're going to do is track that month on month as we go through, understanding straight away that there are regional differences, but I do have a diverse portfolio. I have properties in London, I have properties in Didcot, I have properties in Northamptonshire, I have them in Bedfordshire, I have them in Sheffield, so in Yorkshire. So I am quite diverse in where my properties are. So I'm hoping that this will be somewhere true when it comes to my portfolio. But it'll be really interesting to see how that grows and changes or even shrinks over the next year or two, and we'll be able to track it every single month. So come back next month and you'll see the next month's data as we go down. And I think that'll be really, really interesting. Now let's go back to the data that we've got here and some of the outstanding places that have done really well recently. Wales has been noted as the highest growth year on year. That's up 13.8%. Myself, I'm not really aware of anybody who's investing in Wales, but clearly people are because it's up 13.8%. Yorkshire up 11% year on year, second highest. And the Northwest was also mentioned, with Manchester and areas like that really growing strongly as well. The main laggard at the moment is London. London only grew year on year by 2.5%. Now that's actually below inflation, which is currently running just below 3%. So in real terms, i.e. in purchasing power, once inflation's taken into consideration, London has actually lost value over the last year, where everywhere else, every other region in the UK has increased. So I think that's a really interesting point and something that we should keep an eye out over the next 3 or 4 months. I just want to mention, I know a couple of London investors, one who's fairly large, one who's got about 40 million of property, so not massive, but the other one's in the hundreds of millions, and they have just started buying in the last 3 or 4 months. So really interesting. A couple of them sped up their purchases to get through on the stamp duty, but they are consistently starting to buy now as property prices elsewhere have started to increase and they're starting to switch their focus back to London. So I think that's really, really interesting. Let's keep an eye on that figure. Obviously, when it comes to London prices, the people I know is only a minuscule amount of the value. I completely appreciate that. But it's just sentiment, you know, and I think it's important to just mention. In terms of the HMRC, they have some really good data points for us. So the HMRC conduct transaction data for you on the basis of stamp duty returns. Now, obviously, every time a house is bought or sold, stamp duty form needs to be filled in. So they have very, very accurate transaction data. And we can use this to see how the housing market is performing on a transaction basis. Now, year on year, unsurprisingly, considering COVID, it's up 216%. I don't think this is a particularly useful figure, to be honest. I think more interesting is the fact that quarter to quarter, transactions are down 3.8%. And there's a couple of explanations for this, I think. My first one is that people rushed to get their transactions through before the stamp duty holiday ended. Now that didn't necessarily mean that there was a flurry of activity in terms of extra purchases for the whole year, in my opinion. I think what happened there was people brought their purchases forward, and what we'll see over the next couple of quarters is a flattening off, as people have already moved and already done what they were looking to do. Now, if you consider that the residential to live in market is much greater than the buy-to-let or the investor market, then those are the people that really would have pushed those transactions through quickly. Investors, we're more interested in the whole deal. Yes, a stamp duty sweetener can make the deal look a bit better, but ultimately, it's not going to be the be-all or end-all on any deal that we do. So I don't think it's the investor side, but I do think it's probably the residential buyer side. 3.8% down quarter to quarter, interesting figure. Let's see what it's like next quarter once the last bit of stamp duty relief is taken away. I think that relief ends in September, so let's see what happens then. I think we'll probably look at a flattening off, and then we'll probably get back to some steady growth. I know a lot of people who've got money on the sidelines, a lot of people, so I still think there's a lot to come into the property market. So the last bit of data to go through is the Bank of England mortgage approval rate, and we know month on month it's down 6%. Now that's obviously May versus June and reported for in July. So again, probably the stamp duty holiday playing into that, people rushing to get their mortgages so that they can get that purchase over the line before the stamp duty holiday comes to an end. What's going to happen over the next couple of months? Well, my suspicion is that we'll probably see again the mortgage approval rate just flatten off, and we'll probably see very little change in most of this data. That's my opinion, but obviously we'll see it all play out on this channel, and I think that'll be really interesting. Thank you so much for watching. I hope you've enjoyed this video. If you have, give it a big like. It massively helps me out with the algorithm. Subscribe if you haven't already. Hit that bell notification. Remember, we're giving away the subscriber dividend portfolio every single month, so people are getting cash. No reason not to subscribe. I'm going to give you all this data every month, and I'll see you on the next video. Cheers, guys.